Lots of questions on China, lots of questions on which parts of EM make sense. So delighted to introduce Alethea Leung to cover Asian equities. Alethea holds a Master's in Chemistry from the University of Oxford, is based out of Hong Kong with Man Group, and has worked alongside her Asia ex-Japan equity team colleagues for over a decade, including their time at BlackRock together. We've all been thinking about China and EM in our portfolios for a long time, but there's been a pretty strong headwind called the US dollar for most of the last decade. So we're pretty underweight. We've heard today already a couple of combinations around thinking about this thing differently, prioritising our time on it. So I'm delighted to introduce Alethea to talk to us a bit more about all of that. Alethea Leung.
Good afternoon all. Thank you so much for your time this afternoon. Asia is up 20% year to date, outperforming world by almost 10%. This is after many years of underperformance though. Valuation is still at a discount, and a discount wider than history. And we think this can sustain going forward. The way we invest is based on earnings revisions. Better earnings revisions, market outperforms, and valuation multiple expands. And you can see on the chart here, valuation multiples often move ahead of earnings revisions because market anticipates change. And that's also happened the last 9 months. There are 3 reasons why we think this can sustain and valuation multiple can continue to expand. Firstly, a weaker US dollar is great for Asian markets. And secondly, China is about to go through positive structural changes. And thirdly, beyond China, we see opportunities across Asia. We've already heard from previous speakers about the weaker US dollar. Let me put that into context of Asia. The last few years, Asian economies have seen very strong exports, and that's allowed economies to accumulate foreign currency assets. In the trend of strengthening US dollars, asset allocators have been happy to put these assets into US dollar, unhedged. Now the strong US dollar has reversed. In April this year, the Taiwanese dollar appreciated 10% in 1 month. That's the largest move in 30 years. Now, Asian economies are now looking at the US dollar positions, thinking they now need to start to hedge. They also start to bring money back onshore. In some markets, foreign currency assets is large relative to the size of the economy. For example, in Taiwan, insurers own foreign currency assets the size of almost the whole of Taiwanese economy. If these assets are brought back onshore, we believe this could potentially drive a big domestic asset reflation. In other economies like South Asian markets, real interest rates have been held high because of the strong US dollar, but now US rates are coming down and US dollar is weakening. Asian domestic central banks can now also ease their interest rates and stimulate domestic economy. Now, weak US dollar is great for a lot of assets. Is there more to the Asian story? While China, for the last 2 decades, have been on this investment growth drive, and now they're shifting to consumption. Chinese have always been great savers, but even more so since COVID. COVID and the weak property market have dampened consumer confidence and weakened consumption. The Chinese government has also kept interest rates high in order to keep currency stable relative to the dollar, which is different to 10 years ago, and that has encouraged even more savings. Households' deposits have grown double-digit rate the last couple of years. And now there's $20 trillion in the banking system from household deposits. That's $8 trillion more than the trendline growth from pre-COVID. That's a lot of consumption to be unlocked. Savings will not only be allocated to consumption, but also to investments. Chinese households only have 2% of their wealth in equities, compared to 25% in the US. The government wants to encourage more investments into equities, which is why occasionally we've seen the government supporting the equity market. They've also encouraged corporates to be more shareholder friendly. 1% of household deposit allocation into equities is 7% of the China equity market cap. This will drive a vicious circle where stronger equity markets lead to stronger income, stronger confidence, and also stronger consumption. We've also seen the government announce various demand measures, such as supporting childcare, better elderly care, free public services for migrants, more property stabilizing measures. We think more measures, more policies will be announced. And lastly, beyond China, with the opportunities across all of Asia. 5 years ago, China was half of the Asian market. Now it's only a third. Taiwan and India have increased their significance. Taiwan, I mentioned about a potential domestic asset reflation that's about to occur. There's also a very strong tech supply chain that's benefiting from the global surge in AI. India, we're also getting more positive on. Earnings revisions have stabilized. There has been more monetary and fiscal stimulus that will drive positive earnings revisions and better equity returns. Southeast Asian markets, real interest rates have been high in order to protect the domestic currency. Now US dollar is weaker, US rates have come down. Domestic central banks have also got more confidence to cut their interest rates. In Indonesia, we've seen more coordination between fiscal and monetary policies to stimulate domestic demand. So Asia has outperformed year to date. We think policy changes and earnings revisions will support this. But don't wait for the policy announcements. Markets always anticipate change. Between 2016 to 2017, China markets doubled because of government stimulative demand measures. We think we could be in a similar environment now. Thank you.
Yeah.